We are live.
Good evening, everyone. Actually, good day to people all around the globe. So, India is finally rebounding, and I think over the last 1 year, uh, the pandemic, while it showed its pangs in the second wave, but economy seems to be rather unimpacted, and it's moving in the right trajectory. So, yesterday the economic survey was presented, and India is projected to grow at 9.2%. Even the next year's growth is expected to be close to 8 to 8.5%. Tax collections have been at an all-time high, and GST in January actually showed, the collections were again at an all-time high. Now, if you were to look at what happened in the budget today, there was push all over. I mean, it was a budget which talked about infra. It also talked about startups. It talked about Make in India. It talked about Gift City. It talked about cryptocurrencies, so on and so forth. And it also did talk about simplification. And one of the themes specifically was how the government's been able to make things easier by repealing a lot of laws, and also going into the future, looking at friendly dispute resolution mechanisms. So just before we start this panel discussion, I'd like to introduce myself. My name is Gaurav Mendirata, and I lead the corporate and international tax practice for KPMG in India. Now, looking at corporate tax perspective, there were a lot of changes which happened this year. In fact, this was a year which I would say is a landmark year from an international tax perspective, where 137 countries around the globe got together and signed an agreement, global agreement on tax, both on how to tax the digital economy on the one side, and on the other hand, having a minimum tax rate of 15% across the globe. This is unprecedented. While there were no changes which came in the budget in line with these recommendations or these agreements, but we will see those changes coming in 2023 as the government, as more rules get notified, and changes will have to happen in the domestic legislation. But looking at the changes which have come in the direct tax regime, one of the most important things has been around Make in India. A few years back, both looking at the push on Make in India and also China Plus One policy, which a lot of foreign investors are now looking at, there was a concessional rate of 15%, which the government came up with for manufacturing units which start operating their commercial production with effect from March 23. Now, looking at the pandemic and the fact that India and it takes time to set up things, especially large manufacturing units, there was a wide expectation that that time frame will go ahead, and which it has. Now it has moved to 2024. Of course, the recommendation was for the time limit to go up by 2 years, but it's a start. Secondly, we are seeing the startup boom in India, and so many, and 44 unicorns got created only in the last year. Some of the older ones actually went in for listing. And to keep that momentum going, the income tax exemption, which is available for 3 years out of a block of 10 years for startups, there was a sunset clause for these startups to have been established by 2022. That has been extended by a year, which is 2023. The other theme, especially when the finance minister started her session on taxes, she talked about rationalizing dispute resolution, making it friendly for taxpayers. So a couple of things that have happened. As some of you may be aware now, the audits or the assessments which happen are actually under a faceless scheme, where the taxpayer doesn't know who's actually auditing them. So there have been certain glitches. There have been certain nuances in relation to that. The government has completely taken that into cognizance and has revised the scheme. And some of the key elements are that the transfer pricing, the international tax kind of faceless assessments, and also the tax tribunal have been pushed out by a couple of years till things get streamlined. The other one is a very interesting one where once you file a return, you have some time till to which you can file a belated return, or I mean, if you don't file a return, then you file a belated return, but or you can amend the return by the end of the assessment year. Uh, Sometimes that time is not good enough, and assuming certain taxpayers who discover that there is some income which has escaped assessment, or I mean, which they believe that is something that they should have disclosed. Government has given a open-ended scheme that within 2 years of the end of the assessment year, if that return is filed with the additional tax, and there is an additional amount that you have to pay, which is 25% of the additional tax if you file within 12 years and or 12 months, or 50% if you file within 2 years. Uh, that is a fantastic thing, because then you're not waiting for the tax authorities to come in and start levying penalties, or if you were to go on your own, there was no scheme, and there was a threat of paying penalties on top. So with that, I think the key changes I have talked about, but there are a lot more interesting changes which have happened across the other arenas, specifically talking about gift cities, cryptocurrencies. So I'll invite my financial services partner and leader of our financial services practice, Sunil Badala, to talk through those changes. Thank you.
Thank you, Gaurav, and I think that was a wonderful context. So, taking on from where Gaurav started, yes, there have been a lot of important announcements in the financial service sector. Few which really caught my attention. One is, post office across the country will actually be allowed to offer core banking services. What does it mean? It means that all the post office branches in rural and small cities, as well as of course the big cities, will be able to offer the full-fledged banking services. So they can offer ATM, they can offer online banking, mobile banking, transfer of funds from one post office branch to another, or transfer of funds from post office to other banks, etc. So I thought that was a very, very good announcement, and it actually will give big boost to the financial inclusion that the government has been focusing on for last few years. The other one is around digital banking, uh, and we've been talking a lot about digital banking. So there are 75 districts across the country which will be identified, and banks will be allowed to set up the digital branches. Of course, we await details as to how this will shape up, how this will work. But again, directionally, I think this was a very important announcement. Also, Gaurav talked about gift cities, so let me just jump on to that. You will see a lot of foreign universities and institutions which will be allowed to actually set up their shops in the gift city, and they'll be able to offer courses around financial management, because as of now, as you know, that the foreign universities are actually governed by the domestic law, and therefore it actually it has to go through a lot of restrictions under the domestic law. Those restrictions will not be allowed, and they can actually operate in gift city as if they are operating in their home countries or any other countries for that matter. Also, there have been a lot of exemptions which have been provided to non-residents when they earn income from banking units set up in the gift city, or on account of offshore derivative instruments or over the counter derivatives. uh, the shipping industry has actually been brought at par with aircraft leasing industry within the gift city. So any royalty or interest income arising on the lease of ships, if the entity is set up in the gift city, then that income will not be subject to tax in the hands of the non-resident lessor. Uh, the other important amendment which has been proposed is that any capital gains arising on transfer of ships in the gift city will actually be fully exempt from the capital gains tax regime. So those are the important ones from an IFSC or gift city perspective. Let me just briefly touch upon another important area which I think everyone has talked about today and has been talking for last few weeks, few months, which is the whole taxation regime around digital currency or digital asset. So the government has proposed a new taxation regime for the virtual digital assets, and it not only includes the digital currencies but also includes non-fungible tokens, and some of the other virtual digital assets as notified by the government from a time to time. And what it provides is a flat rate of 30% plus, of course, applicable surcharge on any income on transfer of virtual digital assets. There are provisions of TDS. So if I were to actually sell any virtual digital asset, then the buyer will have to ensure that there is a TDS of 1% on the gross consideration if it exceeds 10,000 rupees. Also, if you were to gift the digital assets to someone else, then the donor will have to pay tax on the entire consideration. And of course, it also gives rise to a lot of questions which everyone is grappling with, and I think in the times to come we will have some clarity on those. The one last amendment which has been proposed is on account of bonus stripping. The bonus stripping provisions are applicable to the units of the mutual funds if you were to buy and sell the units of the mutual funds within 3 months from the or rather prior to 3 months from the record date of the bonus announcement, or after 9 months from the record date of bonus announcements. Now these provisions are actually applicable or extended to the units issued by AIF, REIT, InvITs, and also securities issued by the companies. So any shares, debentures, any securities issued by the companies will actually be governed by the anti-abuse provisions. In essence, what it says is that if you were to suffer loss on account of transfer of any of these assets, then that loss will be ignored. So I think that's about it from a financial service sector point of view. With that, I will hand it over to Vineet Agrawal, who will talk about some of the important changes on the personal tax front. Vineet, over to you.
Thank you, Sunil. Uh, the finance minister for the last 3 years had provided a lot of changes. So this time we have a budget where almost there is very nominal changes on the personal tax side. There is no change in the basic income tax exemption limit or the slabs or the tax rates. They all remain the same, what was there in the last year. There's something on the COVID-related expenses in the sense like there was a press release earlier in terms of the COVID-related expenses which will be paid and how the taxability will be there. Now those things have been brought under the Act. Essentially, what it is trying to say is that if on account of illness, there is some medical expenditure or any expenses which the employer has incurred or any other person has incurred, that will not be taxable in the hands of the recipient for himself or his family. Having said that, if on account of death of a person, if whatever is the employer who is providing any ex gratia, the full amount will be non-taxable. But if that amount is received from some other family members or friends, etc., then an amount up to 10 lakh rupees will be tax exempt only. In addition to that, there is one good thing which the finance minister has brought in the as changes is there is a section 80DD which provides for a deduction for people who are differently abled if there is any contribution which is going into it. It used to have a provision that the policy which is being taken should have a clause where it's only on account of the death. If it is there, then the contributions would be tax deductible. Now that change has come in those provisions, saying that even after 60 years of age, if that thing is part of the scheme, then whatever is the contribution which is being made, 75,000 rupees on account of disability and 1,25,000 rupees on account of severe disability, that is the amount of deduction which will be available for the person who is contributing it. There is a change in section 80 CCD in NPS where they have said that the state governments also, where the employer is making any contribution up to the level of 14% from the 10% which was there earlier, the contribution will not be taxable in the hands of the individual. Now that's for state government employees. Earlier it was only for central government employees. The virtual digital taxation of virtual digital assets which will get taxed is a very interesting provisions for all the people who are dealing with cryptocurrencies and other NFTs. Going forward from the next financial year, 30% is the tax that they have to shell out, where the cost of acquisition will only be the cost of acquisition and no other indexation, etc., will be allowed. Additionally, like even if the VDA is being gifted, it will be liable to income tax in the hands of the recipient, and the losses will not be allowed to be set off. So that's an interesting change which has come up, and it is going to impact the people who are going to sell the virtual digital assets from the next year onwards. Long-term capital gains will on all assets will have a surcharge of 15%. So HNIs who were earning more than 2 crore rupees and were subject to 25% surcharge or 37% surcharge will get a benefit on account of that. So the surcharge on long-term capital gains on all assets will now get restricted to 15%. So that was all more on the personal tax side. Over to you, Anshu.
Thank you, Vineet. So next few minutes, I'll quickly take you through all the key amendments that have been proposed on the indirect tax laws. To begin with, GST laws, the amendment that have been proposed under the GST laws. I would first start with the welcome measures. The first relaxation that the law offers is with respect to an age-old issue, that in case if there is any wrong availment of credit, whether the interest would apply only at the time when the assessee has availed the credit, or it should be applicable from the time when the assessee has utilized the credit, where actually it leads to loss of revenue to the government. Authorities, since the introduction of GST, the authorities have alleged that interest should be applicable on the wrong availment of credit, but this debate is now settled. The interest shall be applicable only upon utilization of that credit, because that's the event which is leading to loss of the revenue. Another amendment that has been proposed in the law is with respect to, if there are any amendments to be done with respect to any transaction in a financial year, for instance, raising of a debit note or credit note, time limit for utilization of credit. Currently, the law prescribes time limit of by the time you file your return for the month of September in the subsequent financial year. The time limit has been extended, and now you can make those amendments or the time limit for the purpose of availment of credit. If you have to make any rectification in your monthly returns, now you can do all this by 30th of November in the next financial year. So there is a clear extension of 1.5-2 months that the assessee gets to make the amendments. Another, important amendment is that currently, if an assessee or taxpayer has an excess cash in its cash balance, and they have, let's say, two registration, they have excess cash balance in the cash ledger of Maharashtra, and but there is a liability that is arising in the state of Delhi, then the law allows that you can transfer that cash from your cash ledger to your another registration, the offices of the same legal entity, but it's a distinct person. You can transfer that cash to the another cash ledger. The ask of the industry has been that there should be a fungibility of credit that should be offered by the government, but that has not been done yet. As of now, the only relaxation is that you can transfer your cash from one cash ledger to another cash ledger. With this, there are certain restrictive provisions that have been introduced, and those are with respect to the availment of input tax credit. The first and foremost, now the government can prescribe or provide the restrictions, on the availment of credit, and they have specified certain parameters. For instance, your supplier has not paid tax, or wrongly paid tax. So those are some of the circumstances that they have prescribed in which the credit could be denied by the government. Another point linked to this is that government has provided specifically that in specified cases, they may block the credit ledger in which the assessee may be required to make payment of taxes through their cash ledger only. Another one, in specified cases, of course, the authorities have got the right to block your credit ledger, or there are cases where they can hold back your refunds if you have not paid your other tax liabilities. So these are some of the measures which have been introduced to put in more restrictions in terms of availment of input tax credit. While we don't have all the details and what are those circumstances in which these restrictions could be introduced, and some of those details we'll get to know once the law has been clarified further. Now, moving on to the customs amendment, the first important one is that the finance minister has specifically announced that they will revamp the entire SEZ law. In fact, they will introduce another law to replace the SEZ Act, which has been currently in place, and certain measures that will be taken to simplify and regularize the customs procedures in terms of a new EDI platform that will be introduced. We don't have all the details as of now, but soon we'll get to know what are the changes that will be introduced with respect to the SEZ Act. There has been a famous ruling of of Supreme Court in case of Canon India, where it was held that DRI doesn't have the power to issue show cause notice. Now, this was a debate since the time of the Supreme Court ruling. What amendment that has been proposed now is, going forward, DRI would not be issuing any show cause notice. The show cause notice would be issued by the jurisdictional tax authorities. DRI will provide the recommendation to the jurisdictional tax authorities, and they'll be authorized to issue the show cause notice to the taxpayer. However, with respect to the past notices where the assessees or taxpayers have questioned the notices issued by the DRI, that has been that debate has been settled, that those notices would be considered as valid notices, and the assessment will take place accordingly. Another interesting amendment that has been introduced in this budget under the customs laws, we have all seen, advanced ruling gaining more attention, but in this budget, it has been proposed that the advanced ruling order issued by the authorities would be valid only for a period of 3 years. Now, this raises a question that if there is no change in the law, if there is no change in the fact, why the order should expire after a period of 3 years, and what will happen once the order is expired, whether there'll be a renewal of the order, whether there'll be a new advanced ruling that is to be filed. So some of those details will be interesting to see in near future. Another step that has been, taken to streamline some of the customs, exemptions or rates is tariffization of unconditional exemptions that have been provided under the customs laws. Now, today, if you see the customs, there is a tariff which prescribes the basic rate, and if there are any relaxation, there are any exemptions that are to be provided, those exemptions are being introduced by way of specific notification. So when you're looking at the rate, You have to first see the tariff, and then you have to see the exemptions, and then you have to decide what is the effective rate that is applicable to your product. Now, in this budget, the finance minister has proposed that all the exemptions which are unconditional in nature, those all will be removed, and the effective rate will be introduced as part of tariff itself. And so that's how it will simplify the process and streamline some of the exemptions that are being provided under the law. So they'll be now part of the tariff itself. Another amendment that has been proposed with the purpose to boost manufacturing of capital goods in India, government has enhanced some of the proposed to withdraw some of the exemptions or some of the concessions which are currently available for import of capital goods into the country. The first being, currently, if you are setting up a project, you can avail the benefit. You can get your project registered under the project import. You can import all the capital goods under that with a concessional rate ranging from 2.5 to 5%. But slowly and gradually, we'll see all these exemptions going away. Some of the essential capital goods which may not be available in the market, there the concessions may continue. However, eventually, all these exemptions are likely to go away, and the effective rate or the BCD would be increased to 7.5% for some of the capital goods prescribed under the law. And similarly, there are exemptions which the government may propose to withdraw, going forward for the capital goods and promote the domestic manufacturing of those capital goods. Last but not the least, of course, we have seen a phased manufacturing plan that was introduced by the government for mobile phones. Now we have seen this PMP getting introduced for the manufacture of wearables, hearables, etc. And slowly, gradually, the duty rate on part of these products are likely to increase. So with this, we come to an end of this session. Thank you, and have a good evening. Thank you, everyone.